What's going on, guys? It's your favorite mortgage lender, Abdel Kawatmi with Got Mortgages. I hope everybody is having a blessed day, blessed week. Supposed to come on yesterday, but got a little tied up, so we're coming on today. We're going to go over probably one of my most favorite topics that we discuss, and that is how can one get their offer accepted in this market? It is so critical in today's market that the strategies that you employ, not just on how high you offer with your purchase price, these are the important strategies that you need to take in place in order to get your offer accepted. Okay. So we're going to start off first in regards to the market. Okay. So we're going to discuss interest rates and market factors. We're going to dive deep into appraisals and shortages and what happens if you do run into a potential appraisal shortage. We're going to dive heavily into specifically inflation and the economy. Today was a big day, the PCE report. It came right at expectations. Guys, if the PCE report did not come in at expectations, we could have easily saw rates trickle right back into the mid to high sevens. Thank God that it actually came in right at expectations, fairly low, meeting the demand. That is going to start giving us some insight. We have 5 more inflation data reports coming out, 5 more reports coming out until we get the information that we have in place for the Fed meeting that's coming out in March. Okay. So it's super, super good that we did that. So again, mortgage interest rates right now, I think I really have a very firm understanding that they're going to start slowly trickling down. At one point, we were at 7.13. I actually created this yesterday. So we'll dive together right now and see where did the market kind of react today and see exactly what that is. And we'll look at it together live. But you guys can actually see literally today we actually saw a drop, which was really, really difficult for us to truly get a firm understanding. It actually dropped to 7.10. Now, if you guys remember, if you attended our Monday market update, I locked almost every single client that we currently have in our pipeline, really as an advanced measure. Now, what we do, specifically within my organization, I'm sure other companies do as well, is that even if your interest rate gets locked, you can do what's called a float down. So if the market improves based on what you've already locked it at, and it improves by a cost of 1%, you can actually bring it to the lower interest rate and not have to charge the client, charge the lender, or anything of that nature. It would be an automatic float down. I was actually successful in doing this. I would say probably around, November, December, we were able to successfully get about 6 to 7 clients successfully with a float down because we saw that big drop where the Federal Reserve went, all right, interest rates were tickling. Then they announced, hey, we may actually cut in March. And we saw that very sharp drop. A lot of our clients were able to take advantage of that, right? Now, again, the boring stuff, what impacts interest rates? We talk about this all the time. I shoot my videos all the time talking about it. Inflation and employment, okay? We just covered inflation, employment. We got the initial jobless claims for the week, and it actually came in at an increase. I think it was about 13,000 new additional jobs in terms of initial jobless claims. Continuing jobless claims came in higher. So we need to kind of see these little fluctuations slowly keep coming in because that's what's going to get your offers and that's what's going to get more homes on the market. So as we continue diving in, mortgage-backed securities is going to be something that we really are going to be looking at too, because what impacts mortgage bonds, like I just said, are the 2 main reports that we really want to keep an eye out for. And the reports are the CPI report and the PCE report that I'm sure you guys have heard numerous times. Those are the things that's impacting. CPI is based on the fixed amount in terms of the goods and the services. The PCE report is based on the measure of the bucket of the goods and exactly what it takes to get there, okay? Fed funds rate we've dove into, different loan programs that we're starting to see that are starting to gain a lot of traction. Typically, again, we're seeing your bank statement, your 1099, your P&L, and your DSCR. Those are the top programs that I'm seeing a lot of different mortgage professionals start to endure. Aside from our FHA conventional, VA, USDA, and all that stuff, the other avenues of scenarios, I've shared this over the last few videos, is FHA single unit condo approval, getting the specific unit approved, doing self-employed 1-year filing where you actually just get 1 year of the client's tax returns, adding non-occupying borrowers. We're doing that right now for a file we resubmitted for a clear, and then actually having a client pay upfront a single premium upfront mortgage insurance. We talk about factors of interest rates. I dove into this based on every single consumer's factor is going to range based on a multitude of different options. this gives us a firm understanding in regards to that. Now, when we dive into now the topic that I really wanted to dive heavily for the next few minutes is how do we get your offers accepted? There's the main three financing contingencies that I want all of us to concentrate on, and that is the appraisal contingency, the finance contingency, and the inspection contingency. Okay. And you have to want to go with your realtor, with your lender, collaborate together. The importance of collaboration when you're placing an offer between the lender and the realtor is critical to making your offer as clean as possible, communicating with the listing agent, setting the proper expectation as to what it takes to get the offer accepted. Every single seller is going to have a unique set of circumstances. Okay. Some of them might be a little older, so they might need some time to move out. Some of them may be just be selling the home because their parents passed away. Some may be just getting a house built, so they might need a little bit of time. Another one might be an investor who's looking to sell it very quickly. It is so critical that our buyers and you yourselves, if you are a buyer out there, get educated and have your realtor and lender do that digging in, because that's going to give you the competitive advantage. I've seen so many deals not go through because a consumer just didn't want to necessarily abide by what the seller was looking for, which is okay because they don't have to necessarily agree, but it does set the tone in place for those to be able to do so. Now, when we talk about getting the offers accepted, always I say one of the strongest points that you do is putting a strong deposit. So if you're putting, say, even 3.5% down on a home, if you could show that you're putting the entire 3.5% down as a deposit, your offer is going to stand out versus somebody who's barely having skin in the game, as we call it, and is doing a little bit less than that. Okay, so that is critical. That is one of our recommendations. Obviously, the most common one that we're seeing is offering above asking. Now, what we do with every single one of our clients, we do what's called a bid over ask calculator. We actually do a statistical analysis with our clients and show them, hey, if you offer $20,000 more, you might be, even if you did pay over for $20,000, statistically, we saw earlier this week, Case-Shiller, the FHFA, CoreLogic, and Black Knight all came out and showed that home values have appreciated between 5.5% to 6%. And if you're placing $20,000 on a $400,000 home, you're 5%. You're literally going to make it back in a year. Okay. And that's just nationally. I think Jersey is even higher. So when we talk about offering above asking, it's the type of market that you're currently in. I also think that it's critical for the clients to be educated. Just because you see a house, getting pushed to offer more may necessarily not be the right aspect, because an agent may, if you see a house for 400 and you offer, say, 480, and the comps and comparables are not there, an agent may necessarily not take that into consideration when they're showing them the seller, because they know it's just not going to appraise unless you truly waive the appraisal with proof of funds. Now, getting the seller's attention, again, this is usually what's going to spark them. Of course, we're in the business. People have built their generational wealth. They want to maximize their ROI on the property, so they're going to get them. The difference is you need to show getting the smallest differences of an extra $5,000 or an extra $10,000 on an offer could literally make or break a transaction and only cost you, hypothetically, an extra $50 to $75 a month. Okay. We talk about limiting the appraisal contingencies. That is critical. When we're dealing with clients and we want to make sure that they limit the appraisal contingency, what does that mean? If you offer higher than the home is worth and you waive it, you have to cover it. If you limit it on that $400,000 example and you offer 430 and you do a $10,000 limit, if the house comes in at 410, you're protected by $10,000. Okay. Therefore, you're in the clear and you can get the house at 410. Okay. So crucial for clients to understand the options that are available. Now, if a house does underappraise, the first thing we always do, even if you waive the appraisal, is we will dispute the appraisal's report. Remember, the appraisal is a third-party independent appraiser. It's got nothing to do with us. What we will do is we will always reach out to both the buyer's agents and the listing agents and ask them to send us over different homes and different listings that they think recently sold within similar specifications. We do it based off of a sales comparison approach. We will see similar homes that sold, and we will actually ask the appraiser to say, take these into consideration, because we don't necessarily agree with the ones that you picked. Okay. We can also revisit financing. What does that mean? If a client is putting more than the minimum down payment, we actually technically can bury the shortage within the loan amount. We'll take the example. A $400,000 home, 10% down, that means that your loan amount is going to be $360,000. Now, that also means the maximum you can borrow on a conventional loan is 95%, not including a special program with Home Ready, but let's keep it simple and 95%. 5% of 400 is what? 20,000. That means that between the difference of 380 to 360, you have a $20,000 technically cushion that you can bury the shortage within the loan amount. It's so critical that clients are educated on these specific avenues, and it doesn't change their bottom numbers. Their cash to close will remain the same. Their monthly payment will remain the same. The only difference is to an extent. With the bank, the house's loan to value is not 90, it's 95. And it doesn't necessarily make a big difference. It's just some things that happen, like if it's a condo, you have to get a limited condo questionnaire as opposed to a full. But to keep things simple, it really does not make a difference. And just because an appraiser has one value assessment of a property, that doesn't necessarily stick with the property. In the next few months, your home could appreciate higher and you could be in a better position, right? We talk about offering flexible closings is a big one too. You have the ability to close super quick, or the seller might be waiting in you to be able to close faster. Okay. So recapping again, the top stuff that I recommend when you're looking to strategize for your offer, we talked about the three contingencies: the waiving the appraisal, waiving the inspections, or limiting the inspections. I really never tell a client to waive the inspection, limiting the inspection to environmental, structural, and foundational, going over larger upfront deposits with the EMD, structuring above askings, offering U&Os, which is use and occupancies, where you basically let the seller stay in the property for a certain allotted time. Now, a lot of times you want to make sure that the seller necessarily is okay with this. Of course, they're the ones that's probably going to ask. Get the attorneys involved and they draft off what's called a use and occupancy agreement, and they will generally have to pay the actual borrower carrying costs for them. So that's very, very common right now, because a lot of people are putting their houses on the market and they may necessarily not want to move until the kids are out of school or until they find something, or like I said, the house is finished being built. So people need to be a little bit more accustomed to that. We have other tactics like offering to pay transfer taxes in New Jersey is about 1%, avoiding to ask certain properties for personal properties and taking it from there. So again, super important for clients to understand it's not just necessarily the highest offer that will get your offer consideration. It's taking all these strategies into place and implementing them the same. I appreciate you guys jumping in. Make sure you guys like, comment, and subscribe. I will catch you guys soon. Have a good one.